Well, good evening, everybody, and welcome to our early summer edition of the Investing Roundtable, our June 2020 session, which we've deemed Tacking Through Turbulence. We were just talking about Apple and the turbulent situation there. Facebook has turbulence. There's all kinds of companies with turbulence. And we want to take a look at that from 35,000 feet and try to share some ideas with you here tonight. And again, hope everybody's summer is going well. I'm joined here tonight by dear colleagues, Kim Butcher from Florida by way of Evansville, Indiana, Ken Kavula from the mid-Michigan area, Cy Lynch from Atlanta, and Hugh McManus. I'm pretty sure Hugh is still in Southern California.
I am. It's been raining too, so.
And you've been there
I'd share that.
An all-time record number of days now, I'm sure.
Yes, the longest now since 1989, longest continuous period of time at home.
Well, my name is Mark Robertson. I'm managing partner and founder of Manifest Investing. And again, we come together for one purpose. We've been doing this now for 9 years and 11 months, which means that our 10th anniversary is on July 28th, basically a month from today, and we hope that you'll all join us for that. We're going to have some fun between now and then, but we have had a blast of a time over the last 10 years, and with no more further ado, other than to mention that picture is a picture taken by our daughter on Lake St. Clair just a couple days ago of a storm rolling through, and beautiful picture on a summery day in the Detroit area. Here's our quick reminder that no investment recommendation whatsoever is intended. This is about education, demonstration, and illustration. And we are attempting to deploy the philosophies and methods of the modern investment club movement as promulgated by Manifest Investing or NAIC Better Investing. This is literally a work in progress that is now 8 decades in the making. And we know quite a few people that have enjoyed a very successful lifetime of investing, and including many of the people on this panel. So good, clean fun to be had by all. If you'd like email reminders about these educational events, we generally hold a couple of them every month. You can send an email to nkavula1@comcast.net. Natalie will not inundate you with emails, simply will remind when we do things like this. If you want copies of the slides or if you have follow-up questions, send me an email. It's markr@manifestinvesting.com, and we'd be happy to tackle it and perhaps take it to the next level. As we said, we've been doing this for 10 years. Basically, here is our agenda. We will talk about how we've done over the last 10 years. We'll take a look at the tracking portfolio real quickly. We have 4 presentations tonight. Ken's got Biospecifics Technologies. I will do Pfizer, perhaps with a little bit of heckling from Hugh on the Pfizer end of things. He certainly knows a heck of a lot more about Pfizer than I do. And Sai's going to present Schwab. And Kim has a real challenging, but I think provocative and potentially rewarding area to dig into. The ticker symbol is, we kid you not, NERD. Is your mother worried about you, Kim?
She always worries about me, Mark.
Okay, you're studying NERD, today, and it's just a.
It'll be abundantly clear to all the others when I do my presentation.
Okay, we'll save it for that then. We do an audience poll. If you're joining us for the first time, an extra big welcome to you, and you are invited to vote when we get to the poll. And we do try to leave a little bit of time. We have a full slate, but if we have a few minutes left over, we will do an open Q&A period. Here's our reminder of what this is about. We've been doing this, like I said, on one Tuesday evening a month for nearly 10 years now. We're sharing an idea and showing a perspective on how to evaluate an investable, actionable opportunity. We do keep track of the performance of the portfolio. We would love to beat the general stock market as measured by the Wilshire 5000 by 5 percentage points. That's 500 basis points if you speak that language over the long term, and we are doing that. We'd like to see half, maybe 60% of our selections actually beat that stock market index over time. And we've done fairly well in that regard also. Let's start with just a quick little characterization of what's been going on in the market. This is a 20-year look at monthly price bars for the value line arithmetic average. It's the companies that are in the value line standard edition. And I think this one is kind of telling because it includes that 2008, 2009 horrible moment in the stock market. We tested all of our patients there for a while, and that was a fairly drawn out and agonizing thing that we went through. And just recently, we have gone through a fairly similar dive, and in fact, it's similar in magnitude, not quite as big, but the gravity and the acceleration and the speed and all that kind of stuff has really been something else. Any thoughts on that from any of the panelists?
Well, I'm getting some questions about the arrow. I think I can guess, but is that arrow pointing at when we began the roundtable, Mark?
That is. We happen to time it at kind of a lapse or a speed bump in that chart after the recovery following the Great Recession began. Anything else?
We also would have some people that would like you to explain that graph along the top, if you could, real quickly.
Okay, the graph along the top, again, this chart is provided by stockcharts.com. That is a free site. You can't quite do this without a subscription, but you can do a lot of other stuff. And the RSI stands for Relative Strength Index, RSI. And it's basically a measure of momentum. And so anything above 70 is a stock that is potentially overbought. Overvalued. And anytime you hear a talking head on CNBC talk about a stock being overbought, they're probably talking about one of those where you can see the green arrow areas up above here. And then again, going back to that Great Recession period, we had a period when virtually every stock in the stock market was oversold back in that time frame. And what really sets this situation we just went through apart, makes it much different than 10 years ago, is I think we had about 14 minutes of dramatically oversold. And when I say 14 minutes, I'm not kidding. I mean, about the time it takes to make a hot dog, and some of you know that story. There were some extremely powerful buying opportunities during these moments, but they didn't last long this time around. So that kind of characterizes the market over the long term. Again, think back to that first picture and tacking and turbulence. I mean, the long-term journey in the stock market does involve some tacking, I believe. It's shown right there. Okay.
Mark, before you get off that graph, Nick would want to know, when did Manifest begin on this graph?
Manifest started in February 2004. So right about there. Okay. All right, one of the things that we have been kind of keeping track of for the last 6 or 8 months, with some concerns about the recession that seems to be forming, we probably are in a recession. What we're looking at here is the net margin on the industrial companies in the value line arithmetic, the very value line standard edition. So it ends up being about 1,400 companies. We leave out the banks and insurance companies and companies where we would pay more attention to assets instead of revenues and net profit margins. So the top chart is actually going back to just a few months ago, and now it's actually about 9 months ago in September 2019, and what the perspective looked like at that time. And you can see that for 2020, 2021, I mean, these were all pretty robust. This longer term trend through the numbers was in pretty good shape. And that all began deteriorating around Christmas time. And in fact, the 2019 numbers came in fairly weak. And I think you can see that 2020 now, the average, this is actually average versus median. The average now is down here, and that's pretty nasty. We're in, I hate the word unprecedented, but unprecedented with respect to this chart. Anytime that number drops down for the average company on a relative basis, what it basically means is the companies that are weaker with lower quality, lower financial strength, they could be in jeopardy of leaving the planet and disappearing from the stock price listings. And we're going through that right now. It's again a work in progress, and you can expect to see a gray shaded area indicating a recession somewhere in here in the near future. So yeah, it's serious stuff, and many of our stock selection guides are impacted, if not destroyed, by this condition.
Mark, just a question. Probably doesn't matter that much for these charts because you're looking primarily at trends. But why did you switch from median to average? Because it seems to me with so many low margin businesses that median would be a much more meaningful measure of profitability rather than margin. Because it get distorted by than average, because the high margin companies would distort. Yeah, and you can see that here, but like I say, we're just looking at trends, so it may not matter for these charts, but I was just wondering if you had a reason.
Just to check and see if it's dramatically different, really. Just wanted to see what it was. And the shapes are very similar. Looking back at the data up through 2018, I mean, the shapes are similar. I think the one on the bottom actually shows those doldrums that we were all feeling in 15, 16, and actually into 17, when it felt like we were in a recession and we had a lot of rotating recessions and that kind of stuff. But yeah, it's just to see what it looked like. And perhaps.
And Mark, I was going to comment. This is Hugh. I was going to make a comment as well that the NBER, that's the National Bureau of Economic Research, which is widely recognized as the entity in the US, at least, which makes a call on recession, did say at the start of the month that the monthly economic expansion peaked in February of this year and quarterly peaked in December of last year, which means that the economy has slipped into a recession, probably at the start of the year.
Yeah, I think we'll start seeing those gray ranges.
Get the gray pencil out.
Yep, and do some shading. Yeah, and again, the reason that we look at this is, again, it goes back to that time frame back in 2008, 2009, when basically our pile of stock selection guides were destroyed and really challenged by these, periods. I would argue that we're probably in the middle of a minefield of outliers when it comes to stock selection guides. That might be one way to think of it. And as long-term investors, it can be very difficult, but we really do have to focus. In fact, I think we're going to talk about that with Middleby here in a minute. If you really pay attention to the near-term recency bias type stuff, you could start getting pretty negative when as an investor, you really want to be in that 3 to 5 year time frame mode of imagining what does this thing look like as we come out of it. So it's just that's what the purpose of these graphs are, is just to remind us that we are in a severe moment, but our attention should remain on, what does United Airlines look like in 5 years, and companies that are struggling right now, that sort of thing. All right, so back to the good news. Let's go ahead and transition. This is our performance over the last 9 years and 11 months. We stand as of the close of business tonight at a 17% annualized rate of return since inception. The Wilshire 5000 over that same time frame checks in at 9.9, so we have beaten the market by 7.1 percentage points, at least at this point. So we're grateful, we're thankful, and we high-five around the water cooler and keep pressing on. About half of our selections have beaten the market, and one of the fascinating things, we covered this last month a little bit, we'll just touch on it briefly. This is a tracking portfolio, so we're actually gauging the results of every single selection, every decision made. We put $1,000 into every selection made by either a knight or a damsel or the audience in the audience vote. And we'd actually made 555 selections and hence invested $555,000 over that 9+ year period. Well, the sales that we have done using our disciplines and rules for selling, we've actually cashed out more than we've put in. We've actually put in, again, that $555,000, but if you actually look at the net cash flow, the proceeds from all of our stuff, we have a positive balance of almost $39,000 and almost a $400,000 pile of assets. So kind of hard to wrap your arms around that, but it's kind of fun to think about it. We're playing with the house money is the way some people would tend to think of it. In other contexts, we were in third place last month. We got passed at the closing bell by Invesco QQQ, the NASDAQ 100 ETF, and Virtus KAR actually moved back into the lead in this listing of very well-performing funds over the lifetime of the roundtable. And the list drops off pretty quickly. We are honored to be near the top of that chart and look forward to hopefully being on this chart as our 10 years comes to an end next month. Here's the tracking portfolio, the top 20 holdings by percent of assets in the tracking portfolio. And again, as we said, anytime a selection is made, either by a knight, damsel, or the audience, we invest $1,000 into it. In the case of Microsoft, Microsoft has been selected 6 times. So $6,000 invested in Microsoft is now worth $44,000. That's been quite a rewarding position.
Mark, are
Yes.
you reading that correctly? I think Microsoft's been selected 5 times.
Oh, yep. My eyes are getting older. 5 times. So $5,000, even better, is now $44,000. So going down that list, you can see the number of repeat selections. There's actually a couple on there, like Costco, number 20. That's a one-time selection, going back almost 9 years. That is now worth $6,000. So some good clean fun. We're going to throw a couple of these, S&P Global and ResMed and a couple others on the hot seat here in a minute. Any comments or surprises, or anybody want to brag?
I was just thinking back in the 90s at NAIC/Better Investing events, they were inundated with people, but the perennial question was, how can I find the next Microsoft? And it turns out over the last 5 to 6 years, the next Microsoft was actually Microsoft. If you could wait. Microsoft had 7 2-for-1 splits over a 6 or 7 year period. It was just unreal.
Yep. Yeah, and in fact, I wrote a piece for Better Investing where I demonstrated that using a traditional stock selection guide, it was never in the buy zone.
Yeah,
you can go back and actually look at that, and that's part of the challenge that we'll continue to talk about in greater detail about companies like an early stage Microsoft, Amazon. You might as well go ahead and brag, Hugh. That's a 2-time selection. Amazon, $2,000 has become $18,000. And we kind of like the fact that Amazon is in the portfolio. And
ResMed's another 2-time selection, Mark.
Yeah, ResMed. We're going to talk about that in greater detail. That's been red hot. You talk about the question we had Barb Kessler asked in the green room tonight about Apple and momentum. It doesn't have to be Apple or Microsoft. ResMed has incredible momentum right now. Kim has had a couple selections with incredible momentum.
Yeah, who was it that picked ResMed, Mark?
Let's not commit one of the 7 deadly sins here.
I mean, I can look it up. I mean, it came up in a discussion about snoring. Now, who would? I don't remember. I'm pretty sure I remember.
We all claim all of them, Cy. Okay?
It's a team effort. There you
All
go.
right. Right. Pressing on. Now, some of you have been out there scratching your heads a little bit about some fairly assertive and aggressive selling that we've done. I underline and bold the word assertive. We really want to try to keep the tracking portfolio in decent shape, and some of that has required really dragging some of our personal favorites, including Apple last month. I mean, I'm not kidding. I was shedding tears as I worked on the spreadsheet to remove Apple from the tracking portfolio. But this graphic, I left it here just as a not so gentle reminder of if we'd actually asked the question, well, what if we hadn't made those selling decisions over the last several years? And the answer to the question is our just buy and hold and basically buy and forget would have delivered approximately a 12% rate of return. And
Wow.
and actually the selling decisions, the managed portfolio actually now checks in at 17%. So that is not an inconsequential difference. Again, urging all of us to understand that if you believe in buying opportunities, by definition, you have to believe that selling opportunities exist and should be taken advantage of. And
Mark, is this a relatively easy slide to generate with the spreadsheet?
it is, but I have to actually go in and delete a bunch of transactions to take all the cells away.
Okay, because I was just thinking to myself, this would be an ideal slide brought up to date for the anniversary show next month.
I will do that, yes.
So I will make one comment about this slide, partially because it also confirms something that my own personal experience confirms. I don't want to take anything away from that bonus 4.5% in the gray area. That's very important. That's huge. But notice even the buy and forget versus the Wilshire 5000. And I'm raising that to say if you believe in the long-term better investing by quality, don't say, gee, I don't have time to monitor my portfolio all the time. Just concentrate on buying quality at good value, and you'll still do well, because there have been times in my life that I've not managed my portfolio as well as I should have, and yet it on autopilot still beats the market.
And Si, just to double down on what you said, I think most of us, if offered a 10-year investment that netted almost 12%, we'd jump at it.
Yeah.
So I agree with you 100% that while selling a lot of times, judicious selling a lot of times can improve the portfolio by sticking with high quality. We're not doing really bad things to ourselves either.
Yep, I would
And then
second all of
I'll
that.
pile on here too, if you don't mind.
Yeah, absolutely.
In the real world, we don't reinvest these quote unquote funds that come from selling, but in the real world, obviously, you would have more funds to reinvest, and the likelihood is you would reinvest them in those companies that have been doing well for you. So I would imagine that most investors out there would actually, if they followed this approach, would have an even better return than the MI, the manifest investing tracking portfolio.
Certainly possible. Sure. All right, let's keep pressing on. We want to finish up the selling part of this before we get into our individual stock presentations. One of the things that we like to do as a standard practice is to check and see which companies have the lowest return forecast, the lowest expectations. They can still be excellent, great companies. And I think these both qualify. In fact, Hexcel has only been in the portfolio for a few months, and Ken brought it, and it's gone up 50% since April. And S&P Global is one that's been in there for 6 or 7 years. Kim brought it a couple of times and is now worth almost $8,000. And those have the lowest projected returns. And again, we want to honor this assertive practice of trying to keep the overall average portfolio return up to suitable levels, and we just have to keep diligently chasing it. So we're going to basically suggest sell the top two. You can always buy them back in the future, And then we want to take a look at ResMed and Middleby as part of our exercise tonight. Cy has taken Schwab off the consider selling table by proposing that it be bought. So we'll go right to that.
Yep, Mark, could I just focus just a second before you turn the slides? Thank you. At the growth column, because I think that's equally important to the par column. And our growth has always been, in the last couple of years, a little bit anemic, our sales growth. So by selling things with a low sales growth number, our growth has finally moved over 11%. I'd be more comfortable with it in the 11.5% range, maybe even approaching 12. So by selling those two slow growers, Hexcel and S&P Global, I think that moves us in the right direction. It'll move slowly. It doesn't happen overnight, but you sell slower growers to make room for faster growers in a regular portfolio. And I think that we should be doing it as an example in this portfolio as well.
Absolutely. Here's a quick look at S&P Global. Again, Kim brought it to us back in this time frame, back around that graph there and that graph there. So you can see that the stock price has behaved quite well for her. And
Cha-ching,
it's a
cha-ching.
ka-ching moment. That company is, spun off from McGraw-Hill and really is executing well on a business plan. This is not even for a heartbeat to say this is a bad company in any way, but notice that the projected return is down around zero. And in fact, in value line, if you look at the value line report, it's actually negative. But again, that's an example of what we were talking about a few minutes ago, a company with exceptional momentum. It's up to about 329 as of tonight's close. I believe it was down around 80 or 90 just a few short years ago, right, Kim?
I think the first time I presented it, it was $79.
Cool.
Because the government had fined S&P Global because they had, in 08 and 09, they had ranked their debt not very well.
They were part of that situation.
They were part of that and had a $1 billion fine, and they just paid the cash and said, leave us alone.
Okay. Well, it's been good, so we could ching and move on. All right, ResMed. Ken, you want to, I believe, Ken, you're the originator of ResMed. You want to expand on some of your thoughts on this one?
This was mine? Oh, great. Okay.
It actually is mine and Ken's. We can.
You guys
I
conspired?
think Ken did it first and I did it second, if I remember right. But
Okay. Well, I consider ResMed to be a core holding in my personal portfolio, and I related to Mark this afternoon the fact that I've gotten in trouble a number of times by selling ResMed too early and then having to wait to put it back in my portfolio. I do notice that the par is negative and the value line number is negative, and I guess you can pull it out of my hands, and I'll shed a number of tears, but at the same time, I understand why we're pulling it with the numbers that we're looking at. So I will sadly bid adieu to ResMed from the portfolio, and then watch it carefully for a time, maybe to reinsert it.
Yeah,
because this stock does become affordable on a fairly regular basis. Now, I don't mean once every other month, but perhaps every couple of years, it does become affordable. It does become a buy candidate for a good portfolio.
Yeah, a little bit of a hiccup in the earnings is all it takes, and it probably does approach the buy zone again. I think the thing that's supporting it, Ken, right now, if you look at the manifest investing consensus of the analysts, the return is in the 4, 5, or 6% range. And the reason that it is they have a PE expectation of 30 collectively. And I have a hard time with that. I just don't see this company being at 30. Maybe it'll get a little bit more robust on the PE, but I have a really hard time seeing this thing in the way distant future at a PE of 30, an average PE. So I guess maybe we do just celebrate and look for another opportunity to come back to, because it is a magnificent company.
Absolutely.
All right, Middleby, your thoughts on this one, Ken?
Did I bring this one too?
Well, we talked about it briefly. I mean, this is.
I'm thinking that we put our rules together about relative return, and when a company reaches more than 20% below what the market's returning, we put it on the chopping block. That's a trigger that we use for a holding that we haven't held for a reasonably long time. And I think Middleby, we just might have been a little bit too early in putting our money into it. It's lost quite a bit versus the market. What is its relative return right now, Mark? About negative 23 or 24%, is that right?
Right, it's trailed quite a bit, and I mean, it's taken that COVID hit for sure.
And we put that trigger in there to help us with the rule of 5, and when I consider what Middleby does, I'm wondering if there's room in schools and hospitals' budgets for kitchen equipment in the next couple of years. I don't think that the consumer, the individual consumer, is enough of Middleby's business to carry the business for the next couple of years. And unfortunately, I think the number of restaurants, at least short term and maybe medium term, is on the significant decline rather than a growth prospect happening for it. So I don't see something that will help it grow in the next couple, 3 years. Long term, I still expect that this high quality company that basically makes equipment for commercial kitchens and people that like to think they're commercial cooks in their home, I really think that there's room for it. It's going to be a great company again at some point, but I'd be willing to pull the trigger based on our rule that when the relative return is more than 20% below the market, we pull it out of the portfolio for a timeout. So I'll suggest that Middleby deserves a timeout right now.
Anybody else? I mean, Ken made a comment about we didn't see it coming. I can't imagine seeing something coming like we've been faced with here over the last several months, and it's just part of the adventure and joy of investing, I guess. We're going to have surprises, and we shouldn't even call them surprises. Standard operating procedure that we're going to have these, and the question is, does Middleby stay depressed as is shown there for 2021, 22, and does it recover back to those 5-year levels anytime soon? Kim, any thoughts on this one? I know this is one of your selections over the years that you followed closely.
We couldn't have ever expected that the stock to be at a high of 120 and it drops to, I think we got it when it was 90, and then COVID happens and it goes to 50s. I just think it was horrible timing of rolling craps. It just happened.
Mm-hmm. In fact, it got down to 40.
Yeah. So one of those that coulda, woulda, shoulda. If I would have even recognized it, I should have presented it the following month, in April, because it's gone from 40 to 78.
Yep. So it's a tough one. I'm kind of stuck in the middle on this one. Just wonder how long it will be in the doldrums. Operationally, forget the stock price. Operationally, how long are they going to be suffering on the regular business end? So, tough one. All right, let's go ahead and move into our programs. Starting with one of my favorites. This was selected. I selected this, as did the audience, about 6 months ago. So, Ken, go ahead and bolster our stock price.
Okay, well, I presented Biospecifics at a Better Investing event, and I presented it a couple different places around the country as I traveled. It's one of my favorite stocks, and I do own the stock. I've done fairly well in the stock, and I'm going to give you some very specific reasons, and I'm going to label this a non-core holding of mine. And I've been kind of waiting for an event to happen. And when that event happens, if it's positive, then I think that I have a good chance of making some decent money. If the event is negative, then I think I have the chance of losing some money, and it's all going to happen fairly soon. So let's look at the next slide. Could we, Mark? Biospecifics is a biopharmaceutical company. It does most of its work in collaboration with a partner, Endo Pharmaceuticals, Endo, E-N-D-O Pharmaceuticals, and they work basically with collagenases. Collagenases are something that break down collagen, and collagen is one of the most common substances in living organisms. It's the main structural protein in the extracellular matrix in connective tissue, and I read that right off my slide, and you can do that as well. When you have accumulations of excess collagen in various places in the body, you have some real problems occurring. Right now, pharmaceutical company Biospecifics, and that's the name of the company, Biospecifics, does work with two particular indications for collagen buildup. And they have a drug called Xiaflex. It's really not a drug. It's a, like I said, it's a collagenase. And the drug, the collagenase, controls Peyronie's disease and Dupuytren's contraction. You can look yourself online what these two diseases are, but they get royalties from Endo Pharmaceuticals whenever Endo sells this Xiaflex to treat these two particular diseases that basically are an accumulation of collagen. The thing that I'm interested in with this drug, this Xiaflex, is how it might be used to treat cellulite. Cellulite is present in over 80% of the population once they reach the age of 40, and it's present in over 90% of the female population once they reach the age of 40. And if you have something that can be used to treat the buildup of cellulite and to reduce the way that cellulite looks when it builds up in a thigh or a hip or a leg bone or wherever it builds up, if you can treat the cosmetic effects of that cellulite, you might have a real winner. Xiaflex is also being tested in a lot of more serious indications. You can see on the slide that they talk about adhesive capsulitis and plantar fibromatosis, which is a relative of plantar, I'm going to forget the end of the word plantar, so I'm going to just move
fasciitis.
On. Fasciitis, that's right. Thank you, Mark. Next slide, please. You all know what cellulite is. It's dimpling, mainly on the buttocks, the thighs, and the lower abdomen, occasionally on the arms. And we're going to get a review decision from the FDA on July 6th about whether or not this Xiaflex can be used to treat the cellulite. If so, I expect that we'll see a lot of folks kind of piling on to the possibility that there's some kind of a workable treatment for cellulite, and the company would expect to launch the Xiaflex indicator for treating cellulite sometime in the first quarter of 2021. Next slide, Mark.
Before we move on, Ken, I just wanted to take a moment to thank you for bringing the word buttocks to a presentation within our first 10 years.
first time that we've had it in 10 years. Okay, we're all set. Okay. The milestones that we're talking about for Biospecifics are that they're going to continue through 2028 to receive these royalties from Endo for the 2 approved XIAFLEX indications for the Peyronie's and the Decuyper. The optimism is expanding this XIAFLEX and using it with other indicators and perhaps in partnership with other companies. And again, there's that cellulite with the July 6th date attached to it. They're also doing treatments or looking at treatments for many other new indications for this XIAFLEX. We've known about collagenase for many, many years, since the 20s, but finding a way to deal with it, this XIAFLEX is kind of a revolutionary way of dealing with the actual collagen molecule, collagen substance. I think it's more than a molecule. Next slide, please, Mark. I went to the roundtable to come up with what I was going to look at tonight. I can get this dashboard right off of the Manifest homepage, and I ignored the 3 with the orange backgrounds just because they were larger than 10% above where the market is right now. I skipped over Schwab because of its growth characteristic. Remember, I'm looking at companies that I'd like to see grow a little bit more quickly. I'm a little bit gun shy of insurance companies right now, so I skipped over Employers Holdings, which is dealing with insurance, specifically dealing with workers' compensation. Universal Display already had a large holding within the portfolio of 5%, or else I would have presented it. And that takes me finally to Biospecifics. It only represents 0.7% of the portfolio, a pretty good growth number of 13%, and a par well above the par in our portfolio, the par of 16.5. If my SSG comes out anywhere near that, then that's the company I was going to present tonight. Next slide, Mark. I looked at the Chronicle. The Chronicle looks really short because Biospecifics only been in the Manifest database for just over a year. And during that year, you kind of look at the blue line, and it's been pretty constant between around 60 and 70. It hasn't done a lot of dramatic ups or downs. I'm looking at the current par at 16.4 for Biospecifics. Quality of 62, that's second quintile, not as high as I normally look at, but again, I'm focused on that date, that July 6th date. Next slide, Mark. I like the lines, especially for a very small company. I think those are pretty straight lines when you consider the size of this company. Only $38 million in sales, but that represents a 19% growth rate in sales over the last 8 years and a 32% increase per year in earnings over that same time period. Next slide, please, Mark. The company's doing everything with virtually no debt. I'm looking at the high PEs and the low PEs. I chose 25 as my high PE and 14 as my low PE. You can see that I moved very much towards the PEs of 2018 and 19 in making these choices. And then I looked seriously at the recent market low price and the average price. To be honest, they weren't too far away from the 46.6 that I would have normally picked in the choices of a low PE of 14. So I kept the 46.6 as a low price. That gives me a buy, pretty good upside downside. There is no dividend. And most importantly, if you'll go to the next slide, Mark, you'll notice that that 17.2 par that my SSG comes up with is awfully close to the manifest number of 16.4. That's validation in my eyes. It's telling me that I can have some confidence in my analysis, and that at least I have the analyst community close to where I am. We're all going to be wrong together, or we're all going to be right and celebrate one of the two answers. So let's add another BSTC to the portfolio.
Sounds good.
I'm going to add this slide to the end of all my presentations going forward. Our par is 12.1. I'd like that par to be 5 points above my par, and 5 points above my par would be somewhere around 14%. So when I pick a par value of 17.2, I am moving in the right direction. I'd like growth, I've told you a couple of times in this presentation, to be 11.5%, maybe even closer to 12. So when I pick sales growth of 15% for this company, I think I'm also moving in the right direction.
All right, well, thanks, Ken. And yeah, Ken has already touched on it. We think it's very important to pay attention to the main pillars of the portfolio design, that being the return forecast of the overall portfolio, the quality, and the quality is not an issue, although it's down a little bit lower than it's been in quite some time. I'm going to see what I can do about that. And the financial strength is at that A level. That could also be a little higher, but again, not an emergency. And again, that growth is extremely important. I'm going to be bringing a company that's got a little bit less growth, so I depend on the rest of you guys to pick one that's balances that out carefully. Again, I thought I've picked some fairly frisky stocks over the last several months, and I do like to do a little bit of editorial balance. So what I put together is a list of all the companies in Value Line that have A++ financial strength ratings. There's 68 companies. I'm showing you the top 20 as ranked by the manifest ranking. Again, the manifest ranking is an arithmetic combination of the return forecast, the par, and the quality rating. So the higher return forecasts and the higher quality ratings should drift to the top of this chart. And it's a pretty good shopping list for core blue chip holdings. And we put our parade of other opinions on here. This is the projected return on owner's capital that we talked about quite a bit back around Christmas time. And what I've basically done is gone in and circled the 5 highest ones. Again, return on owner's capital is nothing more complicated than looking at the 5-year pre-tax income and dividing it by the total capital as measured by the debt and the equity for the particular companies. Again, if you want more on that, let me know, but you can go back on our YouTube collection, look for the Christmas time presentation on Rock the House, ROC, Rock the House, and return on owner's capital. Here's that relative strength index that we talked about a little bit earlier, the relative strength index via stock charts. Anytime it gets down around 30, maybe 40-ish, companies tend to be perhaps a little bit more on sale. So I'm just highlighting the 3 that have the lowest relative strength index, hopefully catching them on the way back up. But these are companies that have potentially been beat up a little bit. In Pfizer's case that you can see here, Pfizer, the company that I'm going to pick, they've been beat up because they did fail an FDA test level with respect to one of their breast cancer treatments just a few weeks ago. And they've taken quite a beating for that. The 52-week position, this is that Irish thing that we do in honor of Hugh McManus. We do like to, when at all possible, shop within striking distance of 52-week lows. And Hugh insists that he loves to shop for companies that are within 20% of the 52-week low. In this case, Pfizer and AT&T fit that description right now. The Value Line low total return forecast straight off the company reports is on display there. That generally matches up fairly well with our overall efforts. We do recognize that Value Line can struggle mightily with early stage companies. The Morningstar price to fair value, again, that's nothing more than the current stock price compared to their fair value calculation based on their fundamental analysis. Anything under 100 is potentially on sale. I have circled 3 of the lower price to fair value ratios by Morningstar. Next column over, same thing, only in this case it's the analyst consensus for the analysts that are covering these companies. And again, circling a few of those. I was telling Ken before we got started, I actually had my finger on the buy button for FedEx this morning. That 57 was just calling out to me, and I didn't do it. Next thing I know, they close, and I think they're up 15 or 18% after hours. So, darn it. 1 year expectations really aren't that big a deal for us, but it never hurts to find a stock that's undervalued to the extent that it's got a lot of wind at its back, wind in its sails for the tacking that we do. And we see Pfizer, Northrop Grumman, and Raytheon Technologies. There is a military industrial complex theme here if you look for it. The Northrop Grummans and the Lockheeds, and Pat Donnelly recommended that some shopping in that area might not be such a bad thing for core holdings just a few months ago. So I'm going to go with Pfizer because it's got the most boxes circled. Pfizer, no stranger to any of us. It's a flash in the pan. It only started almost 200 years ago as a company. They do have a relatively new CEO, and he's completely reshaping the company, restructuring the company. They are dealing with companies coming off patent, and their pipeline is actually in better shape than it's been in years. And if Hugh is on here, Hugh, you can chime in at any time. These guys are working in all of those areas that we've talked about during the FDA presentation recently, the oncologies, the rheumatology, the immunologies, the cardio stuff. Obviously working in some
they're right across the
areas.
board.
What's your general outlook on Pfizer from a pipeline perspective, Hugh?
I think Pfizer's a very strong company. It always has been. It's very adept at making acquisitions. At the time, the Warner Lambert acquisition had people scratching their heads. They paid a lot for it, but it was a great acquisition. It's just a very successful company.
Yeah, and it's been really going through kind of the working in the trenches over the last several years. In fact, dating back to your infamous moment with Better Investing when you questioned its future there for a few years, about 20 years ago. And I believe you got some rather negative mail regarding your editorial comments.
It was overvalued for a while, but it has bounced back. And I've owned it since, quarter of a century, I think.
Now, everybody and their brother is working on a virus cure for COVID-19. These guys are no exception. Do you have any insights on their standing? I know they've been described as one of the 5 most likely companies to come up with a solution.
Yeah, they've partnered with the right people. They're doing the right things. We just have to wait. It's just really hard to know. A virus is just a strange entity and extremely hard to predict. I mean, it always ends if the virus mutates itself out of existence because of pressures that are put on it, be it a vaccine, herd immunity, another version of the virus that's much less virulent but much more infectious comes along and crowds it out. There's just a host of things that happen. But we just have to wait and see. There's no good way to predict.
So they are collaborating with some very potent partners. And again, I've highlighted that word restructuring because, again, I want to make it clear that we're not dealing with up, straight, and parallel here. This is a company that has completely restructured itself. And when we're talking about restructuring, we're talking about their product portfolio, stuff coming off patent, stuff being divested, some acquisitions. They just had an acquisition of I forget the name of the company, but it has to do with oncology. It's a relatively small company, but they paid a huge amount of money for it. So they must have very high expectations. So what it comes down to is the historical data, because of all the spinoffs, the product portfolio, part of the product portfolio that they've actually let go. And they're in the middle of some joint ventures in that regard, even right now. So the new guy is basically repositioning this company. You can't pay a whole lot of attention to the historical data other than they have a lot of sales, a lot of those billion-dollar drugs, more than most companies. But you really have to focus on the right-hand side of this chart and the company as reconfigured. And we're looking at a company, you can see the reconfiguring taking place trying to boost the sales a little bit, and notice that the resulting product portfolio is expected to have higher profit margins. Notice that here's a sign of restructuring in progress, the PE going crazy on this company and settling back into more historical norms. Notice that if you really do focus in on the right-hand side of this graph, we are beginning to look at an expectation of up, straight, and parallel, slightly different trajectory. So in summary, we're looking at a company growing at, again, it's a $50 billion company. The spinoffs are continuing this year and some of the stuff that they're doing right now. But the end result is expected to be a company with a growth rate somewhere in that 5 to 6% range, again, with improved profit margins and actually returning to more historical PE levels. Those three core assumptions actually do net, especially following the recent downdraft in stock price following the disappointing breast cancer results. We are looking at a company in the teens for a projected return, and I like this even better. The projected return on owner's capital is in a really nice spot at 11%, and the relative strength index, again, one of those keys that we looked at to find a company that might be just whispering, I might be a little bit on sale. And it's just some real nice characteristics for a company that has been very reliable for almost 200 years. So we'll go ahead and put them back on the pile and hope for some good news here in a few days on some of the stuff that they've been doing. And who knows, maybe they'll buy Biospecifics or something and make everybody happy in the process. So with that, let's go ahead and switch over to Cy and Charles Schwab.
All right, thank you, Mark. Everyone can see relatively up, straight, and parallel here. Of course, you see coming out of the dip in the Great Recession, as you would expect, and a little bit of a dip in the middle of the chart around 2015, and then some slowing recently as well. Value line has a decent 18-month potential return, as well as the low projected 3 to 5 year forecast of 14 is in pretty good shape as well. So a couple of quick screening points off a value line there. Next slide. Again, those of you who've been following closely see this is basically the same thing Ken did, pictured just a little bit differently, but we both looked at the portfolio ranked by par, and I decided to choose the highest green and went with Schwab. Same issues with the yellow stocks that you see. Air Lease does have a high quality, but I'm not quite ready to jump in quite that contrarian. I figured picking a bank and a investment management brokerage company was as contrarian in this environment as I wanted to get. Next slide. I did not do a screen of, or at least show the slide of a screen of manifest, which I usually show. Just suffice it to say that Schwab, out of the screen for high quality companies, would be the highest green, and it would be a screen populated, as somebody observed, I guess last month on the slide, with a lot of financial companies. That's just the environment we're in. This is a quick industry study ranked by quality, looking for the highest quality companies. You see two companies that are excellent quality, Schwab and TD Ameritrade, which may end up in the long run being the same company. You see are the two that have solid return projections as well as quality. And the latest news on the Schwab TD Ameritrade merger is that it's still looking to close later this year. So we'll just see if that happens. Next slide. Just a real quick look at what Schwab does. It's well known in our community, as well as to roundtable attenders. So don't need to go into great detail on it, but it's much more than a broker. I did not realize that it was the highest publicly traded total asset firm, but you see it has more assets under management than any other publicly traded company in the United States. They serve as custodians for independent advisors, and then they also do retirement planning, asset management for employers, and then it's a bank on top of all of that, primarily doing banking related checking accounts for sweep and check writing for brokerage customers, as well as mortgage lending are kind of two of the areas that they accent on in the banking. Next slide. Here's just some screen captures from their website that give you a few statistics. There's their assets of $4 trillion, their total brokerage accounts. Notice they've got quite a few retirement plan, and there's the banking accounts as well, employers, and they are also big in the mutual fund and ETF business. And while those are proprietary funds in that they are managed and sold by Schwab, following the trend in independent-minded investors and money managers, many of those funds are index and low-cost type of funds. So they're not your what I might call your traditional proprietary funds that are not necessarily good deals for the investor. Most of these tend to be pretty good deals for the investor. Next slide.
That's a great point.
Here are my judgments. I chose to continue to evaluate Schwab along the more, probably shouldn't say traditional, because better investing pretty much goes with assets or sometimes net interest margins and interest income projections. But I just did the traditional better investing methodology for revenues as opposed to the manifest things. Also, there's a strange quirk also in the beginning numbers in the independent Eagle on manifest. So I just chose to present it this way. Notice net margin of about 30%, 6% growth, which is right in line with the projected asset growth consensus on manifest. And also it ends up with a bottom line of $3.25 projected earnings per share, which again is in the range of the consensus on manifest. I think it's a tad under the manifest consensus. It's just about right in line with the value line, 3 to 5 year projection. Using an average PE of 20.5 comes to a 17% projected return, which again is just slightly below the manifest consensus. So there might be a little bit of a potential surprise on the upside, but I think that Schwab isn't going anywhere. It's a very solid company. Your guess is as good as mine as whether this is the greatest time in the world to buy an investment manager bank company, but you could have said that for probably most of the last 5 years or so as we're in a maturing economy. So I say let's add another Schwab to the portfolio.
Okay, thanks, Si. I'm reminded of Jeremy Irons' speech in Margin Call, but I'll save that for another time, about what can go wrong in investing over the last 400 years. Right, Kim, are you out there?
I am out here.
I got to warm the audience up for this one. Now, the audience, especially longtime roundtable enthusiasts, will remember how successful we have been and how much of a mystery has been involved with NetEase, ticker symbol NTES. There's a bunch of clubs in this area that have NetEase in their portfolios, and that's part of what Kim is going to talk about here. And I got to tell you, I mean, I have a hard time imagining arenas full of 150,000 people watching a bunch of people play on computers. But apparently, Kim, you believe that this is real and want to share that with our community.
Well, obviously this is not a core holding, but when something catches my eye of currently we've got this COVID going on and there's no sports getting played on TV, and I cannot tell you how many folks I know, especially the guys, are complaining there's no sports to watch. And then you find an article in the paper saying some 20-year-old is getting a contract for $10 million to play computer games online for esports. I'm going, I don't understand this. But if they're making money, there's got to be a reason. So I kept thinking, we've got this COVID going on. There are no sports. Is there something else out there that could be making money? And I found an ETF. Granted, we're usually always simple stocks, but this is an ETF that is called NERD, N-E-R-D. Now, esports is simply electronic sports, which is a growing business of playing videos and games in front of an online or live audience. And this is really huge in China and Korea, and it's starting to gain traction here in the US and Europe. But the numbers of growth is it's crazy. I mean, absolutely crazy. And with it going on like this, my thought was, next slide. Okay, we all know sports as baseball, football, hockey, basketball. But when you look at the demographics, ironically, the average age of a Major League Baseball fan is 57. And their socioeconomic area in what they're earning money at that time, they're getting to their peak earnings period. Well, ironically, in esports, their demographic is the 18 to 35-year-olds. So tell me, how many 18 to 35-year-olds do you see watching a baseball game for 6 hours? They don't do it. How many go to a hockey game where it's cold? Because I've read also where currently the thought process is professional sports as we know it like this is pricing themselves out. Why? Because you spend $200 on a ticket, you've got travel time, then you've got food, a beer's costing you $12. You got to have a lot of disposable income to do that. And how about if I just say maybe quite a few of us in this audience are of that age group, but the younger demographics who grew up with computers in their hands all the time, what are they doing? Well, it's interesting that the average age in esports is 18 to 35, and they've not reached their peak earnings. One of the statistics I found was that in watching a final in the viewership, this is fascinating. More people watch gaming than HBO, Netflix, ESPN, and Hulu combined. I'm like, huh? I'm not even a gamer. The biggest thing that I do is I watch a YouTube movie on TV. You know, sports or games, that's not me at all. So when you think about this, I found out that in viewership, here is and how many of us have got kids and grandkids? That's all they're doing is they're looking at their phones. And when you think about it, the audience growth from, there's a website that does a lot of this research called newzoo.com. this growth is going up 9 to 10% per year. And I know, Ken, you've done a presentation on Amazon and why you thought it was a good buy. But how many people realize that in the Amazon fold there is Twitch? And Twitch is their online gaming. And look at how many hours of live streaming, 2.7 billion hours in the second quarter of 2019, which is 72% more than live hours watched, besting YouTube Live, Facebook Gaming, and Mixer. That's all this gaming stuff. And I'm like, oh my God, makes no sense. But obviously people are doing it. There's lots of money in it. So when you think about it, these younger generation people, these Generation Zs, they're used to this high tech. And so look how much money is invested in it when you add it all up. 45 billion in the titles and the esports games that they have. They have their services, the hardware, the computers, the headphones, what the content is. It used to be that you got on a game on Xbox, you had to buy the game and you played through it and then you were done. Now people get on these games and they're free, but embedded in them are little gems that you can buy here and change your avatar to look like this and buy this little thing to help you do whatever the game you are to make you be better at it. There's also an aspect that's on betting with it. And there's the publishers and the leagues. And this is a big deal when the owner of the New England Patriots spent $60 million to leverage and make sure he had 2 esports teams on, for what? To make sure if the football is not still getting played, he's got esports football going out there. Now that's kind of crazy. Yeah. Now this is how the growth of the viewership is. And, you know, now I have heard League of Legends, but I've never heard of Riot Games League. And this is how it's challenging regular sports. Now, if you look at this first graph, this is the finals audience in viewership. So you have the finals of the Stanley Cup and the National Hockey League, and it was 11 million. The NBA basketball finals were 32 million. Major League Baseball, 38. Esports has already surpassed those three at 58 million people. But the NFL, all they have to do is double a couple more times and they will be. And look how much the audience is growing on it. And when you think about it, for me, I've read in my reading of this that professional football may not last in 10 years due to the cost, all the brain trauma that they've got going on, all the risks that are associated with it. And when you've got professional sports, each one of them have their own risk factors, and it can cost so much less that they get to sit in their recliner at home and do their sports. It's something that's a risk for those traditional sports to continue, and that's why esports is taking on so well. And the last 3 months with what's going on with the COVID, this nerd has like popped like out of the world. And one of the things is this ETF is really interesting because they have 11 different countries that are represented because they pick the best gaming sports stocks, which is all aspects of the sports, of the communication, information, consumer discretionary. They've got small, large, mid caps in there. It includes the games, the hardwares, the media. So it includes everything, and it's across the board. So, you know, if I wanted to try to do this, I certainly wouldn't be able to do it on my own to buy, you know, any stock that was in Korea or something. They have 30 stocks within the portfolio, as well as they change it every quarter to see where the growth is going to be. Mark has been able to grab this and see how it has gone up. And if you just look at the blue lines in the middle, they're kind of all going straight up, folks. You look at the RSI. Now it is oversold at 74. I wanted to bring this to the audience just to make you aware, put it on your radar screen. The stock closed today at 21.19, but the net asset value on the stock is 21.01. So it's within 18 cents of its net asset value. Next slide. Mark made a dashboard of some of those stocks within there. We don't have enough data on them all, as you can see.
Yeah, and we'll try to put together a fund coverage on the ETF. And I'm kind of excited because I think this is going to drag us into some small company potential for our work that we'll be doing over the next several months. And we're always up for another Turtle Beach or NetEase. And this is
Right.
another good place, a source of ideas, I think.
Well, yeah, that the other thing is the biggest thing for me is on the website that has Nerd, the Roundhill Investments, who started the ETF Nerd. They had a little thing there that was really interesting, is that in the first quarter of 2020, the days at a premium were 38, the days at net asset value were 1, and the days at a discount were 23. Well, obviously, those were the days when the market took a crap. Now, it's very hard because in 2019, the whole year, the days at a premium when it was over its net asset value were 134. Days at the net asset value were 6. And days at a discount were only 8. So if anybody wants to consider getting this ETF, this would be my speculative play of 1-2% of the portfolio, because when you have partnership with Michael Jordan, that he has an NBA esports, and the New England Patriots, Robert Frost, and he put in like 60 million. Something has got to be good, because these guys are not going to be throwing away millions if there was not money to be made.
Absolutely.
So I certainly hope everyone will just open up their minds and think of this as a possibility for something you can consider, and just maybe watch it to see how it's going to grow forward.
Okay, just kind of wrapping things up, Kim, I think the way that we'll go about this is we'll continue to monitor it. We won't add it to the portfolio, but we'll monitor it. If it reaches a relative strength index of equal to or less than 30, or if it goes into the sweet spot after we have a representative analysis of the fund, either one of those conditions will trigger a buy for the tracking portfolio. So I think that'll handle it pretty well. All right, so Ken, are you ready to poll a will?
I certainly am, and the poll is open. Folks, which one of the 3 presentation stocks would you like to put in the portfolio? Choose one. It won't let you choose more than one.
Even if you're from Chicago.
If you're having a hard time voting, I've been told that you need to put your projection on full screen in order to vote. If you're on partial screen on the computer or on your tablet, you will have a hard time registering your vote. I'm going to count to about 10. We have 85% of the audience voting. So let's see if we can push it to 90, 87%, 88%. Come on, folks, just 5 or 6 more. 89%. And we're not going to make it, so I'm going to close it down. Here we go. And let's share the results. And we'll add a second holding of BSTC to the portfolio. Looks like Pfizer was a fairly close second, and Schwab a respectable third. Those are 3 good numbers for. We've watched a lot of times these votes be very lopsided, but that's a pretty tight voting pattern right there.
So I'm supposed to forgive the audience this time around. Is that what you're saying?
You could, yeah. You came in second, Mark, so you can forgive them this time.
All right. I'll adjust my Christmas card list accordingly.
Okay,
All
I
right,
give
so
you things, but you can continue.
all right, so let's go ahead and talk about coming attractions. You want to go ahead and take it
Yeah,
away, Ken?
next month we are going to celebrate our birthday. There'll be virtual gifts for everybody and virtual awards for the winners of various categories. It's always a fun evening, so join us at the next roundtable on July 28th. That's the last Tuesday. We're going to attempt to visit the Cleveland area on September 12th. If COVID rears its ugly head before then and things turn around, we can't guarantee that we're going to be there, but September 12th looks better than July 12th at the moment, at least. We're going to try to be in Indianapolis on September 26th, and my own chapter is running its Stock Pickers Breakfast in Saginaw, Michigan on November 14th. So place those dates on the calendar. Folks, if you could just wait a little bit, maybe until October, late September, October, to ask us to put dates on our calendar, we would really appreciate it because we just don't know what's happening, just like you don't know what's happening. And my wife has me on a very short leash as far as travel is concerned right now.
Me too.
So, Mark, Natalie, has you on a short leash as well? Okay.
Absolutely.
All right. So, Mark, we have some questions that maybe we can get taken care of after the session, but right now, why don't we close the session and thank everybody for being here. We will try to answer maybe a dozen or 15 questions. We have a lot of them, however, and we will not be able to get to every single question this evening. Okay?
Hey, Ken, could I just make one comment? Somebody asked if you could update people again as to where they could get copies of the slides.
Yep, we're going to do that right after we close the session, Hugh, okay?
Perfect.